Imagine waking up today, January 17th, 2026, and checking silver markets only to find prices ripping higher again, now flirting with triple-digit levels that fewer analysts saw coming. Some indicators show silver up more than 25% in just the first weeks of 2026, building on an already explosive rally where prices climbed an extraordinary amount in 2025. Spot silver has broken long-standing price ceilings as record amounts of physical metal were demanded, inventories shrank, and investors poured into silver-linked ETFs, treating silver not as a speculative asset, but as a core store of value and industrial commodity all at once. But here it's the part that most mainstream financial headlines aren't telling you. While the quoted price on your screen tells a story of rising demand, the underlying market structure has fundamentally changed. Banks, exchanges, industrial users, and investors are now facing a deeper stress that doesn't show up on regular financial charts: the divergence between paper silver and physical silver. A disconnect that signals tension in the global supply chain and a hidden crisis in inventory liquidity that could shatter how markets price precious metals. At the heart of this shift lies a quiet but dramatic reality. The price that banks and large financial institutions don to want retail investors to fully internalize isn't just the number you see per ounce. It is the pressure building in the physical silver market. This pressure has pushed inventories to multi-year lows, strained vault systems from London to Shanghai, and left refiners and major holders unable to hedge efficiently. That's why some exchanges have resorted to special margin hikes, and why the system of paper versus physical settlement has almost reached a breaking point. In today's script, we are going to unpack every layer of this unfolding situation, from the tightening physical supply to the widening paper-to-metal gaps, from the strategic hoarding of industrial users to the silent repositioning by large financial players. Most importantly, you will understand what 120 silver actually means in 2026, not just as a headline price, but as a marker of systemic strain that even mainstream finance is struggling to explain without sounding alarmist. Start with the basics. Global silver supply and demand have been in deficit for multiple years, a trend that has only accelerated recently. According to institutional data, the silver market has experienced a supply shortfall for 5 consecutive years, with deficits compounding each year due to the imbalance between production and usage. This persistent gap has eroded above-ground stocks and forced markets to draw down inventories that once acted as buffers. In 2025 alone, estimates place the deficit well into the hundreds of millions of ounces, with some industry reports suggesting a cumulative imbalance that drastically outweighs annual mine output. While mine production hovers around 800+ million ounces annually, total global demand, including industrial applications, investment purchases, and fabrication, has climbed above 1.2 billion ounces. That means nearly half of total demand isn't being met through new supply, forcing markets to deplete stocks instead of building them. But what makes silver unique, and more vulnerable than gold or other commodities, is not just this deficit condition. It's the fact that silver serves both as a monetary metal and an essential industrial metal. Roughly 60% of global silver demand is industrial, consumed in solar panels, electric vehicles, high-end electronics, and even AI hardware. Unlike gold, whose primary demand is investment and central bank holdings, silver has a dual purpose that tightens supply risk on 2 fronts. As industrial demand continues to rise while mine output remains constrained, since most silver is a byproduct of other metals like lead or zinc, physical supply becomes harder to allocate. Vault inventories in major global hubs have fallen sharply, with London IS Bullion Market Association vaults showing multi-year lows and COMEX registered stocks dropping precipitously since 2020. These falling inventories aren't just numbers. They are the lifeblood of physical market confidence. When inventories tighten, the ability to physically deliver silver upon demand becomes strained, increasing volatility and risk. Concurrently, global macroeconomic environments, weak dollar pressure, interest rate expectations, geopolitical uncertainty, and central bank accumulation of precious metals have all contributed to changing the calculus of silver. Retail investors are not just watching from the sidelines. Retail buying has surged into silver ETFs and physical products like coins and bars, further drawing down supply that could otherwise cushion the market. This isn't a short-term momentum play. The context we see today is the result of structural forces, not just speculative waves, and that is what makes the current silver environment unprecedented in modern markets. Now let us talk about the twist that most financial commentators aren't drilling into. the truth behind paper silver versus physical silver, and why this divergence could be the real story behind today's price action. In most commodity markets, futures prices and spot prices remain closely aligned because arbitrage, the opportunity to profit from price differences, brings them back into sync. But in the silver market today, that mechanism has broken down. We're seeing historic levels of backwardation, where the spot price, the price for immediate delivery, exceeds futures prices, a condition rarely seen outside extreme physical shortages. Think about that for a second. Backwardation usually signals that the metal people can get now is worth more than what S promised for delivery later. When that happens, it S a signal that supply cannot keep pace with immediate demand. Physical metal is simply scarcer than contracts suggesting future delivery. It's not an abstract concept. It's a market stress indicator. The implications of this are profound. The COMEX, a dominant marketplace for silver futures, has vast amounts of contracts outstanding, often representing hundreds of paper ounces for every actual physical ounce in vaults. This imbalance means that if a large portion of holders suddenly demanded physical delivery instead of cash settlement, the system's inventory might not be able to honor that demand. Historically, when futures markets outgrow physical supply by too wide a margin, markets can experience delivery failures, forced cash settlements, and severe volatility. Even more revealing is the behavior of prices in different regions. Shanghai and certain Asian markets have shown higher premiums for physical silver compared to Western paper rates, reflecting localized physical tightness and strong industrial investment demand that outpaces supply. Such regional price divergences are early signals of physical scarcity that go beyond mere headline price spikes. Meanwhile, refiners and bullion dealers report severe backlogs and skyrocketing lease rates, the cost to borrow physical silver, which soared beyond historical norms, indicating that even entities that process and refine metal are struggling to source inventory. This isn't normal volatility. It's structural stress being revealed in real time. In essence, while the quoted 90-plus price on paper charts captures broad sentiment, the real price tension lies beneath the surface, in the physical metal that exists outside of paper promises. And that is the twist the banks and major financial institutions would rather keep off the front pages. So what does all of this mean for you, the investor, stacker, or curious observer? The implications are both opportunities and risks, and neither should be taken lightly. First, if the disconnect between paper and physical markets continues to grow, it could fundamentally destabilize the pricing mechanism for silver. In extreme scenarios, markets could see forced cash settlements where exchanges choose to settle contracts in currency rather than metal delivery because the physical isn't available, a move that could weaken confidence in paper pricing and lead to sudden repricing events. This is why the term locked silver isn't just a catchy headline. It reflects a reality where physical metal becomes harder to access than the digital or paper price suggests. Second, investors need to be aware that retail and industrial demand are different forces. Retail flows can create short-term volatility, but industrial demand consumes real metal in ways that don't reverse easily. Solar panels, electric cars, electronics, all of which require actual silver. When governments, manufacturers, and global buyers compete for the same finite stock, prices reflect that competition in real time. Third, if the narrative of a structural physical shortage continues to dominate sentiment and real deliveries tighten further, central banks and sovereign investors could also reposition their holdings toward tangible assets, amplifying upward pressure even more. That means silver could become not just a hedge, but a strategic reserve asset, a shift that would change how it's priced globally. On the risk side, markets with unresolved structural imbalances can be extremely volatile. Sharp corrections, like the ones seen when passive funds rebalance out of silver into other commodities, can happen quickly and without warning, especially when paper markets readjust to new flows. This is why understanding the difference between paper price trends and physical supply dynamics is so critical. In short, this isn't just a trading opportunity. It as a structural shift that could redefine how precious metals behave in a world of growing industrial demand, strained inventories, and macro uncertainty. Ignoring this deeper reality could leave investors vulnerable to sudden market shocks. If you've been following silver's recent trajectory, the number 120 per ounce is no longer just a hypothetical target. It is a price point reflecting real-world structural pressure in 2026. The physical market is under unprecedented stress. Major vaults in London, New York, Shanghai, and Singapore are reporting inventory drawdowns that are historically extreme. In the past week alone, sources from COMEX and LBMA have indicated registered stocks falling by over 10 million ounces, while retail demand for physical silver coins and bars continues to surge. Fiat.com. Banks, hedge funds, and bullion dealers are now trapped between two irreconcilable realities: the surge in paper contracts they manage versus the tangible shortage of deliverable silver. JP Morgan, HSBC, and other global players have reportedly repositioned their paper holdings, attempting to hedge or cover, but any misstep could trigger rapid repricing. Some insiders suggest that certain funds are short covering aggressively, creating localized spikes in spot prices, an unusual situation not observed in decades. BullionWatch.com. At the same time, industrial consumption is at record highs. Asian and European electronics manufacturers, EV battery producers, and solar panel fabricators are absorbing silver from physical markets as fast as it can be delivered. China's strategic accumulation programs, recently leaked, indicate that the People's Liberation Army and related industrial conglomerates are securing billions of ounces for both defense and industrial applications, tightening supply further. SmartStockTrading.com. This convergence, paper squeeze, physical shortage, and industrial demand, is the hidden story behind $120 silver. What mainstream media calls market volatility is actually a market reaching its limits, where conventional pricing and delivery mechanisms no longer reflect real-world constraints. The U.S. Mint, for instance, is still processing back orders with weeks of delay, and Canadian and European mints have suspended certain allocations temporarily, signaling a systemic bottleneck. GoldSilverMining.com. Here's the twist. Even if paper contracts remain abundant, the real risk is in physical accessibility. Investors and stackers may find that the number on the screen is irrelevant if vaults and mints cannot supply the metal. This is why $120 is not just a price. It's a signal that physical silver is now locked in warehouses, strategic reserves, and industrial hands, leaving the rest of the world chasing a dwindling pool. BoringCurrency.com. For retail investors watching from home, there's a profound takeaway: timing and method of exposure matter. Buying paper ETFs may offer short-term exposure, but the long-term structural imbalance favors those holding physical metal. Coins, bars, or other deliverable forms now carry more than investment value. They are tangible security in a market where paper promises increasingly outstrip actual availability. YourJonig.com. Finally, the broader implication: this situation isn't likely to resolve in weeks or months. Structural deficits, industrial demand, geopolitical accumulation, and financial stress suggest that silver prices could see multiple phases of repricing over the next year. $120 may be just the first milestone. Analysts hint at potential for $150–200 in 2026 if current trends in supply scarcity, industrial demand, and financial positioning continue unchecked. WarAndMysteryChronicles.com. So, to summarize the twist, what looks like a standard price move is actually a convergence of systemic factors. The banks cannot freely deliver, industrial demand is surging, and strategic accumulation by sovereign entities is locking metal away. Retail investors are in a race against both time and scarcity, and understanding this structural reality is more important than chasing a headline number. The market charts flash $120, silver vaults are tight, futures contracts are stretched, and industrial factories hum as they pull in every ounce they can secure. The banks are playing catch-up, the exchanges are under strain, and the world is slowly waking up to a silver market unlike anything in modern history. This is the moment where knowledge, timing, and action intersect. The lesson for viewers is clear. This isn't speculation. It's market reality in motion. Understanding the story behind the price, the physical constraints, and the paper versus physical dynamics will define how investors, stackers, and institutions navigate 2026. Silver is no longer just a commodity. It is a signal of broader systemic pressures, a tangible representation of scarcity, and a glimpse into the future of financial markets under extreme stress. For those ready to act, observe carefully, focus on deliverable physical metal, monitor industrial and sovereign buying patterns, and track exchange inventories daily. $120 silver is not the finish line. It's a wake-up call, a twist in a story that's just beginning to unfold.